Well, it's 10 o'clock, and I think everyone's managed to come in through the waiting room. So, welcome to you all for joining this monthly call that hosted by Nikko Asset Management. Great lineup of speakers this morning. But firstly, you probably noticed if you've been on this call a few times that the background for me here is a little bit different to normal. So I want to firstly express my thanks to Waikato Tainui, who are hosting me down in Hamilton today, in order that I can still participate in this call whilst travelling on the road. So thanks very much to them. Also, for a number of you, you probably won't have met Brett Winton before. Brett is the Director of Research at ARK Asset Management. He's familiar to a number of us on the call, but I don't think he's actually participated in one of our webinars before. So welcome, Brett. Thank you for joining us. Brett, we're really interested in what you're going to say. I'm going to throw this over to you in just a minute, but I believe the broad thrust of what you're wanting to take us through are some of the big ideas for 2021, what you're looking at within ARK, and also in particular, answering some of the questions that sometimes come up around, has this whole area of disruptive innovation, is it starting to peak? Are we reaching the end of this road? Are we starting to see sort of capacity constraints and those sorts of things? So as you look into the future and where you think this is going, we're really interested to hear what you've got to say. So I'm going to hand over to you, and maybe a little bit of time for Q&A at the end of the 30 minutes.
Yeah, and actually I may bail into a presentation, but I'm more likely going to try to just go off the cuff and talk about how we think about markets and innovation, and try to be responsive to the Q&A, because I'm sure a lot of people have those questions and you're getting a lot of inbound. So if you think, first of all, ARK Invest, we were founded in 2014. Kathy and I got together and said, what's the best way to align portfolio management and research to invest directly in disruptive, innovative technologies? And the reason we thought it was the right time to focus on disruptive innovation is because it's a unique time in technological economic history. You really have to go back a century to see the amount of technological foment that's happening today. A century ago, it was the telephone, electrification, and the internal combustion engine. Today, we think there are 5 fundamental innovation platforms. The way I think about it is future historians will look back upon this time period and say, oh my gosh, gene sequencing and editing, AI and neural nets, collaborative robots, energy storage, particularly working through the drivetrain and mobility space, and cryptocurrency, were all hitting critical stages of inflection and cross-sector penetration, all in the same market cycle. And it's really unprecedented, and actually there's a lot of value creation happening as a result of that. And so kind of within the context of asset management, you should focus on the area where the most value is being created. And so from our perspective, it seemed natural that you would want to set up portfolio management and research to focus on exactly that most fertile terrain for both value creation and misunderstanding. And so kind of those are the 5 technology platforms that we think future historians will say that was as big as computation or as big as the internet. And we use a framework for identifying those where they all follow steep cost declines. They all are cross-sector technologies. And actually that's a strong kind of test for whether or not something's ready for a critical stage of inflection. And they're all platforms on top of which other innovations are being built. And those characteristics actually align really poorly with a lot of the kind of structural impediments that traditional buy-side managers have or have evolved over time that tend to make these technologies more misunderstood. Steep cost decline doesn't manifest in 3 or 6 months. It's actually the drama of the unit demand you get is over a medium-term time horizon. But Wall Street, for all kinds of reasons I could go into, is increasingly time compressed in terms of its ability to look forward. The media environment's a contributor to that. Going into passive funds, you're literally investing while looking in the rearview mirror, hoping you don't run into a tree. Even within the hedge fund space, it's people get paid based on the performance of their fund annually. And so, an analyst who makes a good call as measured over 5 years is going to get fired before that 5 years occur. And so we intentionally take a medium-term point of view. All of our underwriting of individual securities is over 5 years. We pretend as if we're going to be a forced seller of our positions 5 years from now, meaning that we don't we don't act like we're selling to techno optimists. We say, given this, what the business is going to look like 5 years from now, and the cash flow we think the business could generate, what would someone who's going to pay a normal market multiple for cash flow, given the margin and capital intensity characteristics of the business, pay for that business? And so we really try to actually be quite conservative in our underwriting, but we do it over a time frame that we think is appropriate for the duration of the equity market. Technologies that cut cross sector are misunderstood, particularly by sector specialists. The automotive analyst just doesn't have the time to figure out how the cost declines in batteries is working, or even to compare it against fuel cells, which we've done a lot of work on. And so they basically rely upon the executives that they talk to kind of let them know when it's a technology that's reasonable and interesting to pay attention to. And they've been misserved by doing so. And so we assign our analysts by technology rather than by sector. And that allows Sam, who covers batteries for us, for example, to think about where exactly in the value chain the value is going to accrue. Is it in the utility space? Is it in the renewable space? Is it in kind of the battery component supplier space? Is it the battery manufacturers themselves? Is it at the tier one suppliers? Like, where is the cash flow going to accrue as a result of the transition of the drivetrain over to electrification? And then, because these are platforms of innovation, traditional Wall Street has a very closed-minded attitude towards the information it generates. We think that's really dangerous when you have platforms that you can't pre-imagine all of the ways in which they're going to be used, and the fail cases, the ways in which they're not going to work, and it's not going to be possible for them to kind of navigate in that direction. And so your only hope in kind of staying current and keeping your probable state of the world point of view accurately reflective of the reality of what these technologies are capable of is to attract a lot of information to yourself. And so the way that you do that, and I think within the internet age, is you provide a lot of information. So we're open with our research. I might not even run through any of it, but I'd encourage you to look through our big ideas deck. It kind of gives you a glimpse at some of our forecasts. That information generation attracts a lot of people who want to talk to us about, oh, how did you get to that battery cost decline? Have you thought about solid state batteries, what that means for Tesla's positioning in the marketplace? And so we're not going to be the expert on all of these technologies. In fact, the Venkat, who's a theme developer for us at Carnegie Mellon, is much more expert on lithium-ion batteries than us. But we do kind of like the business model ideation about how is this thing going to piece together? What do we think is a reasonable forecast? And then he serves as a great sounding board for saying, oh, well, this is how you should think about how these characteristics of these batteries will change with solid state batteries. And this is what I'm seeing in the lab in terms of their manufacturability. And so kind of having an open, we call it an open source research ecosystem, really allows you to not shut yourself off from the areas where you might be wrong and where you might be right about the likely future state of technology. Okay, so those are the inefficiencies that we exploit in the equity market and when we put our investments to work. So far, we've been successful. The question now is, oh, well, but there's been this huge run up and everybody's focused on innovation, and suddenly every time you open Twitter or the newspaper, ARK is in the news. Is the show over? Have we reached the end of the game and the game has stopped, I guess, is the question, right? So let me set up the state of play. So of the 5 technology platforms, there's 14 underlying technologies that we focus upon that we believe are that kind of in our taxonomy, they construct to build up to those 5 platforms. And they're all at critical stages of inflection. They are all investable, and they're all areas where we think cash flow will accrue within kind of the competitive landscape. And if you look at our underlying attribution of market cap to each of those 14 technologies, and you stack it up at the end of 2019, you had roughly $7 trillion in attributable market cap across those 14. And so to give you a sense, that was roughly 10% of global equity markets. And end of 2020, sorry, that was, I 2020 passed so quickly. End of 2019, it was 7 trillion. End of 2020, that same stack was 14 trillion. So kind of disruption of the coronavirus clearly pulled forward the adoption curves on a number of our technologies. Companies, like when you go from a blank slate and people are just forced to, they're not just going to stick with the decisions they've made, they're forced to reevaluate their decisions, how they're operating in the world. Disruptive technology tends to win, because typically the economics and productivity generation of a disruptive technology is much higher than the status quo ante. And so kind of on top of which, everybody forced into digitization, businesses all having to go online like this, there's a lot of productivity generation you've gotten out of that transition. And the assets have performed, and so people have poured money in. And so the question is 7 trillion to 14 trillion. Okay, so now it's like 20% of global equity is in this technology stack. Is that overvaluing kind of like where the ultimate horizon is? And from our perspective, that's absolutely what our job is to do, is to look at both at the technology level and at the individual security level. How do we underwrite our positions to make sure we're providing a reasonable return on capital for our clients measured over a reasonable time horizon within the equity market? Well, the good news is, across our portfolios, especially after the last few days, on the underwritten positions within our forecast set, we still think we have a lot of inefficiency in the market. Now, I reserve the right to be wrong with my forecast. So everything I'm saying is not a promise of return or anything like that. I'm just saying the way in which our 5-year price targeting looks is that we have still over 5 years, more than double in the portfolio. And if you go at the technology level, so if you approach it from the top down level, where we look at our attributed value to each of these 14 technologies within the stack, we think that by 2025, there will be $28 trillion in attributable market cap to these technologies. And then by 2030, roughly 75 trillion. So you can think that it's 75 trillion is basically the size of the global equity market today. So you can, a crude way to think about it is like, we basically expect, if you could somehow get efficient exposure to all companies exposed to these technologies, the value of those exposures would roughly double if you could somehow index it, right? So that's where I at least take comfort that, whatever happens today, I think I'm putting good money to work that will provide outsized return as measured over 5 years. And actually, if you look at the expectations for growth in that 5th out year, across our technologies, most of them are still in an inflection phase. And as in, I think I'm going from 28 to 75, so a more than double again. So it's not like I am just getting to maturity at 5 years. We actually think that they will still be in kind of a state of growth and penetration at that time frame. So that's kind of the overall.
One area that links in with this, which we get a few questions on, is when something has run so hard for a period, like as you say, it's doubled over the last 12 months or so. The question that often comes is, what happens if people want to sort of cash in some of those gains, and we start to see some of the cash flows from investors turn? Does that affect marginal pricing? Are you going to struggle with some liquidity if people want to take some gains, if those cash flows were to reverse? And are you seeing any I guess evidence of that?
Yeah, for us, the short-term volatility is actually good in that typically the way in which we are managing the portfolio is that the market's latest mania operates at a different vol cycle relative to our fundamental pricing of the positions. So you can see it in how we've managed Tesla over the last, call it month, right? Where Tesla has been the largest position in the portfolio continuously. It got up to, north of 10% as we were taking gains off of it. And then over the last month, it's traded down. And we've begun adding to the position, because it's trading down relative to our price targets. Our return is improving upon it. I think that there's there's like a slightly broader question, like the market. There's clearly a lot of like signs of misbehavior in the market, broadly speaking, as in the GameStop thing, a lot of retail options activity. Our actively traded ETF is being heavily shorted right now, which I don't think is a sign of good health. Not casting a value judgment against it, but it's like and there is clearly like options activity on our actively traded ETF. I don't think that's an appropriate way to invest in an actively managed fund. And there is not that is what it is, right? Like the way I think about it and the way I think about my own exposure to our funds is, when I'm investing in equities, my time horizon is consistent with an equity linked duration, which is not 3 months. It's like at least a business cycle. Like if you are worried about what's going to happen over the next 3 months, then you're in the wrong asset class, right? And so like your mix of assets should be what controls against the vol in the equity market. You can look at the total equity market and say, oh, well, it should normalize to a something PE or something. Like, the equity market could be down 30%. I don't know. I actually think it's easier to forecast what's going to happen for us over 5 years than it is over 3 months. And I feel confident about the 5-year point of view. Now, I think Kathy has her own point of view on that, which is she believes that there's so much money in bonds and fixed income that if it begins seeing underperformance due to rates rising, that could kind of like try to find another home in the equity market. There's clearly a lot of people trying to stay wealthy out there who are accepting, subnormal returns in kind of coupon generating assets. I think that from my perspective, I'm able to put client money to work in really inefficiently priced assets. And so then I feel good about, additional client money. Does that make sense?
Yep. Thanks, Brett.
Yeah. I mean, I think that one of the funny aspects about, or actually just like another thing is, like, if you look at some of the assets that are priced out there, we do the work on them and we absolutely think they're overvalued and we don't invest. Like that's our job, right? So, we've done a lot of work on fuel cells. It's very clear to me that kind of the companies that are tied to fuel cells and that narratives that people are building around expectations for fuel cell deployments are not reflective of the actual unit economics of those technologies in the future. And so those assets are the securities tied to those assets are inefficiently priced in the opposite direction. And so from the perspective of someone who is not just hearing something amazing at a cocktail party and deciding to invest in it, but instead saying, oh, let's actually do the work and understand the cost decline there, model out the unit economics for that exposure, attribute the, what is the actual, we believe, 5-year value of that security. It gives us a lot of opportunity for, doing well by our clients with good exposure selection. And so particularly in kind of like this SPAC space where companies are coming out with, I would say, lighter and perhaps inappropriately light levels of disclosure as to what their actual business prospects are. There's been, I think, a lot of good work that we've been doing. And in terms of thinking about how to deploy, invest relative to an environment where a lot of things are going up that don't make sense. it gives you good opportunity to exhibit selection.
Yeah, and clearly it's been a phenomenal run of success, not only in terms of performance for a number of the ARK strategies, but also cash flows have been exceptionally strong over the past 12, 18 months or so. Has that caused any particular problems or strains within the process that it's almost been, the cash flows have almost come too quickly or too hard, or have you, just give us an understanding as to what that's meant for your process and finding the companies that you like.
Sure. The process hasn't changed. I think that there's if you think about the way research and portfolio management interacts, we're kind of generating kind of the scoring for the company. So we have 4 subjective scores we do for each company, plus a thesis risk, plus our expectations for returns. And then giving guidance on incremental news so that the portfolio can be traded tactically relative to what's happening within the world. And there's no doubt that we have more market impact with our decisions now than we used to. And that has benefits and drawbacks, right? So if we want an allocation in an IPO, we can get it. Right, that previously was not available to us. We did not have the same attention from, investment bankers and management teams that we currently do. And because we have like a 5-year price target, if there's a price impact on a security that we invest in, because people have seen that we've invested in it, and then it gets bid up, we're going to be we're not going to continue to chase price. We require a 15% compounded return to put money to work. As measured over 5 years, and sometimes it'll appreciate beyond that, and we have other places to go. At the same time, narrowly, that initial money in, actually the IRR on it is very high because you put some money into a position and it appreciates meaningfully just on the basis that somebody knows that you've signed off on it with your seal of approval. That is what it is. I think that there's also even at the information generation level for our entire research team, like we get more information flow than we previously did. So if the kind of seeking to understand and develop forecasts for the future in any area, we can easily, talk to the companies and the product leads in the private or public space to help us refine those forecasts, to help us understand the critical weaknesses and strengths. So I'd say that in terms of the portfolio management, there's more opportunity because of the vol that induces. In terms of the research, there's more basically access to information if we want it. And then the counter to all of that is, like, ideally you're always entering the marketplace and getting exactly the price you want for the asset you want at the time that you want it. And practically that doesn't happen with a very small cap stock. If you look at our historical outperformance, it hasn't come from small cap stocks. So it hasn't, I don't think that if you look at our expected returns across the entire portfolio right now, I think Tesla's a top 5 in terms of inefficient pricing in our view, right? Meaning, and so that's not a small cap stock. It's quite liquid. So that gives you a sense. I think that clearly the state of the business has changed. We're hiring another analyst for Asia. We're gonna add a fintech analyst. So we have more research resource to work with as well. And then, like, you can back up a step and think about within I guess our quarter end fourth quarter end AUM was something on the order of 58 billion or something like that. We think that the investable pool we're operating in is $14 trillion. So there's not, would you be, there's not a situation where I'm like, oh, I don't have enough ideas right now that are inefficiently priced. That's not an issue for us at all. I think that there are like ways in which we're being tactical about how we deploy, but we don't lack for opportunity by any stretch.
Do you have a minimum cap size of stock that you are prepared to invest in for liquidity reasons, and has that changed as you've grown?
I'm not like the expert there to answer that question, but from a research perspective and things that we're interested in researching, we haven't changed our process at all. And the reason I can't, it depends on kind of the product and the prospectus of the product. I think there's some variance there. So that's the, short answer.
Yeah, Brett, I'm conscious that we're just about out of time. You're going to leave us with one big thought from the 2021 outlook. Is there one thing that you draw our attention to and want to highlight to us?
Well, I think the most exciting space is robotaxis. Like, I think that basically the cost per mile to go from place to place has been the same, or go from point to point in a car, inflation adjusted, has been the same for 100 years, like 75 cents. And the Model T, you bought it and you account for all the maintenance and everything else at 75 cents. If you can deliver robotaxi, meaning that cars drive themselves, you ride in the back seat, we think that'll profitably price at 25 cents a mile. And so you create, it's this, for one thing, it's like a lot of innovation. It takes non-market activity and it turns into market activity. We're all amateur drivers and some of us are very bad at it, right? So you take out that non-market activity that you're not getting paid for and you turn it into a market service layer. So there are, I won't walk through all the math, but it's very easy to underwrite and forecast to more than $1 trillion in operating earnings for the robotaxi platforms that provide that service. And I don't know what you want to pay in terms of a multiple of operating earnings on a software platform, but the market right now is paying 19, 20 times, well, actually well north of that, but at equilibrium, kind of like the 19 times, for stable platforms. Okay, so then that would suggest a $20 trillion market cap opportunity there. That's in 2030. So it's like creating a new sector out of broadcloth, right? And right now, if you look within, we classify those within energy storage. If you look at the way in which the market's appreciated in the SPAC space and the ex-Tesla space, it's been in a lot of electric vehicle manufacturers that haven't really produced electric vehicles in a meaningful volume yet. So there's actually been kind of appreciation, I think, in the wrong spot, in part because there's not like clear investable assets tied to that, aside from Tesla, and you can get a stub in Waymo, and GM has some exposure, but we have some concerns there. So the potential for like a monumentally large company in that spot is very high. And if you look across our forecasting, across the 5 technology platforms, the incremental value accrual from a growth basis is actually more in the robotics, energy storage, gene sequencing, editing, and cryptocurrency space rather than the AI neural net space. And so that a lot of people are trying to get innovation by being basically allocating to the hyper large cap tech. It means they might miss, or at least they're not well positioned yet for some of these vertical exposures that we think are going to accrue a lot of value within disruptive technology. So.
Yeah. Brett, look, we really appreciate your time. We thank you for your insights, and we look forward to hearing more as this journey evolves over the coming years. And you've given us a little taste for the future, and we'll wait to see it happen. Thanks very much indeed for your time.
Right. Cheers.